Good morning, everybody. Um, Shout out to all of our friends and family that are listening. It's Thursday the 18th. No, it's Thursday the 19th of March. This is the morning blast with myself, Ryan, and of course, Michael Brown. What a day. It's a beautiful day here. Okay, the sun is shining. Sparrows are shagging in the bushes. Yeah, what's not to love? Unless, of course, you look at energy markets and the Middle East. But there you go. Just a reminder, this is a live recorded podcast. No editing goes in. So apologies for saying shit, fuck, or bugger. Nothing we say is trading or investment advice. Hopefully we add a bit of value to your day, put a smile on your face. Michael Brown is sighing already because he's part of a WhatsApp conversation that I'm in, and he's very
I wasn't
disappointed.
actually sighing about that. Very good morning, by the way. I was more just exasperation at the amount of nonsense going on at the moment. I don't know what day it is.
It's Friday, right?
I fucking wish, mate. Honestly, it's been quite the 24 hours, I think, for markets and for the global economy. And it's going to be another sort of spicy 24 hours ahead by the looks of it.
Indeed,
how
it is.
things are shaping up this morning.
Indeed, is it? It's just as we were suggesting that, maybe we're getting lulled back into a little bit of a sense of security. Vol could be ticking down. Then all of a sudden, and obviously we'll go into more detail, Israel decided to hit one of Iran's gas fields, and Iran said, fuck this, we're going to now target one of Qatari's gas fields, and it's all kicking off. It's like a scene of Mad Max over there. But anyway, more of that in a second. Before we crack on with that, let's get a quick recap on the price action yesterday and if technicals are going to hold, the technicals to watch. From our dear friend Clive Lambert over at Futures Techs. As he starts off with, there is a hell of a lot going on. Indeed, there is. S&P back eyeing the 200-day simple moving average after a big breakdown yesterday. 67.19 is a reference on a recovery. Pardon, sorry?
Oh, sorry, a man has just appeared to fiddle with the door of the room.
Oh, God, you know what? You had me up until the last couple of words there.
Sorry, that rather threw me there for a second.
Speaking of Clive Lambert,
oh no,
the DAX, quick moving on. The DAX saw weakness back through 23,279, is now testing a bigger picture Fibonacci support at 23,106. FTSE futures also failed to sustain a bid above 10,359, which has cheered the bears. Remember, it's roll tomorrow across equity indices, triple, quad, which depends on what contracts you're trading, in what products, etc. So one to watch there. Obviously, it's a Friday as well, so de-risking. Obviously, everyone's scared of the weekend. There's a hell of a lot going on. Fucking hell. Fund futures, German government bonds sold off and is back at the recent low at 125.68 this morning as we've gone to print. Holding for now. Below here will be printing levels last seen a year ago when 124.67 was the low and the bounce of the move. So that'd be one that the guys will be looking at. Remember, bond prices down, or treasuries down, bunds down, gilts down, yields mean up. So this is not good news, and this is something that I'm sure Michael will touch on briefly in a second because the UK is in a spot of bother.
Again,
well, more, but yeah, just not again. Yeah, it's not like we came out of being in bother.
There is that, yeah.
T-notes also sold off back to 111.07 to 11 for now. Eurodollar gave back all of Tuesday's gains and more, might well retest key supports at one spot 13.91 and one spot 13.67. Bitcoin saw some more red yesterday, which wasn't a big surprise after failing at 74,500, now sitting around 70,000. Gold and silver, obviously gold, the yellow metal, both saw red yesterday, and that continued overnight weakness seen back to 47.03 on the yellow metal. The rest of the metals complex is following suit. LME copper is now testing a key Fibonacci level at 12,075. I, for one, really fucking hope it bounces. Well, otherwise I'll just have to buy more. If in doubt, average. This is not trading advice. Not trading advice. Oh, God. Oil markets kicking off again, obviously, as the whole energy sector is. I'll read it out, but you could, in 10 minutes, it could be completely different. It was probably completely different from the time we wrote this, or Clive wrote this. But oil markets kicking off, as you will know. In case you've been living under a rock, Brent is well bid up to 115 this morning. WTI has been more muted and still shy of the $100 level. Obviously, that spread is blowing out. As I said yesterday, I remember fondly that having a 25 tick daily range, and it's actually on the exchange traded spread. It was known as the ARB, and everyone in the industry called it the ARB. It was. I'm not going to say it was a nice free money little side hustle, but it was a little free money little side hustle. But fuck trading that now. Now, there's many reasons why this is blowing out. I see Tracy listening. Tracy's put out some stuff in already on this. You know, Brent, it's seagoing. It's far easier to ship across to Asia, etc., and it's more in demand at the moment. So that's very much the paper. That's the back of the envelope version. But follow people like Tracy, Chai Girl, etc., for more in-depth analysis.
Even if you could fucking say it.
Yeah, if I can get me words out. This is the thing. I'm feeling much healthier today, so I'm just giddy with excitement. What else we got? Gas oil making new highs for this move this morning, hitting resistance of 13.51 and dates back to June 2022. Above that 14.22.5 is next. Although I've scrapped the half levels. I don't think anyone cares about the 50-cent levels at the moment. Just trade gap wise in dollar ticks. This is an all-time high set in March 2022, very spiky. US gas, Henry Hub, rolled over to May contract. Free spot 291 is resistance to watch there after seeing green yesterday. TTF, now that's the story that a lot of tourists are now looking at, which is obviously European gas, a product that we mention most mornings. That gapped up big this morning. Yesterday's high was 56.37.5, and this morning we've seen $74 print earlier on. Again, you could be reading this, it could be trading 100 by the time you listen to this. God knows what's going to happen there. EU carbon. I'll tell you one thing that's not going to happen is UK is not going to pump more of our own nat gas. But, there we go.
Ed Miliband is a cunt.
He is. Oh, I love it.
I hope the AI picks that up.
Yeah, I love it when you use that word. I feel like I've created a fantastic, sexy monster. Yes. Yeah, sorry.
You should have heard that the desk this morning for the last 2 hours since we've all been here has literally just been that on repeat. So thank fuck we don't have a swear jar in.
I've missed the days of sitting on a desk. As Clive pointed out just then, the TTF.
We could bring you in as an intern.
Oh, I'll do.
You're the right height.
Yeah, I'll bring some.
Can you make a good cup of tea?
I'll bring some knee pads.
Oh,
sorry, those days are long gone. Sorry. Flashbacks to when I was a runner. Sorry. Gobble. Sorry, Clive was very keenly. Clive is on WhatsApp keenly pointing out that I said, I think it was TTF, I said, or gas oil, I said was dollars, it's euros, or whatever it was he said, I can't remember. No, yeah, TTF is euros. EU carbon market still seeing some selling and is targeting 63.26 to 30 for now. Interesting one. Again, completely off topic. Things are going to benefit from oil and gas being sky high in terms of energy, right? People might laugh at me, but I really do think, and I've not seen, again, I've spent less and less time on Twitter, thankfully, recently, because I've got better things to do, quite frankly. I just wade in and post a meme occasionally. But I'm kind of thinking that coal might be something that we want to be looking at as an investment at the moment, or things that benefit from coal prices or coal miners and stuff. Because I tell you what, a lot of the green energy lot's going to go out the window when you're paying a fucking gazillion bucks for gas.
Yeah, coal is the short-term sort of solutional fix, and then nuclear is the longer-run.
Yeah, well, exactly. Because like Germany, especially, there's a lot of coal-fired plants that are out there in Europe, especially, and that are very willing to be spanned back up and to full. A lot of them are still just idling over just to keep them so they don't have to shut down. Because I'm not an expert on this, but I do seem to recall that there's some kind of system in place, kind of like a still smelter, where if you let it run cold, then it's basically impossible to restart. Again, I might be completely wrong here, but I don't know. Just the thing I'm going to be looking at today is kind of.
It's all right though, mate. We've got a windmill, so we'll be all right.
We got a couple, which Ed can stick one of them up his arse because he wants. Actually, just before we go on.
Oh, this drinking warm beer thing.
Yeah, so basically, Ed Miliband. So those are wondering out there, Ed Miliband his department have put out this kind of fucking toolbox or something for hospitality sector. Like apparently it's on the web or something, and it kind of comes up with ideas where you can save energy. One of them is to serve warmer beer. Now, I'm sorry, but you can come after me for most things. If you start coming after the temperature of my beer, I'm going to be down in Westminster throwing windmills myself. Right? See what I did there? But quite frankly, as I said on Twitter yesterday, the day before, if he's really serious about that, he can stick one of those wind turbines right up his fucking ass. But anyway.
Well, indeed. While he does that.
So you crack on. I'm going to go
on topic.
Yeah, sorry.
Let's start with the geopolitical stuff because, rather unfortunate timing. We said on the conversation yesterday that it looked like markets were getting somewhat desensitized to developments in the Middle East. We have had a pretty major escalation, I would say, in terms of the conflicts over the last 24 hours or so. And the reason for that is because it now seems that energy infrastructure within the region is a target. Now, exactly. Now, this started after an Israeli attack on the South Pars gas field. This is by far and away the biggest gas field in Iran. Axios later reported that this strike on energy infrastructure was conducted solely by Israel, but that it was conducted with the approval of the United States, with Israeli sources noting that the attack was aimed, and I'm quoting here, at signaling to Iran that if it continues to disrupt oil supply through the Strait of Hormuz, there could be an escalation in the targeting of its energy facilities and a subsequent worsening of the economic crisis in the country. That's according to the Israeli officials that Axios had cited. Safe to say that I don't think that warning has worked out exactly or entirely as they were expecting, because what we have seen happen since overnight is a significant retaliation from the Iranian side, basically attacking various gas and oil facilities across the entire Gulf. So in Qatar, for instance, there's been reports of extensive damage at the Ras Laffan LNG plant, which I think is the biggest in the world, I'm right in saying. There's also been quite considerable damage to various energy facilities in Bahrain, targets in Saudi Arabia, although the majority of those drones were intercepted. And this morning, we've had further reports of drone attacks on energy infrastructure in Kuwait as well. So it does appear that energy is now kind of fair game, as Ryan just said, in terms of the conflict. And I think this is a big issue for financial markets because, of course, commodity supply and the global economy. Because, of course, commodity supply was very, very tight already as a result of the Strait of Hormuz being essentially impassable. In many respects, though, that is, I don't want to say it's an easy issue to resolve, but once you ensure transit through the Strait of Hormuz, you essentially go back to normal. The problem now is if we are looking at energy infrastructure in the region being damaged, that is a much longer time frame to restore things back to normality because, of course, not only has the damage got to be brought under control, it's also then got to be repaired. And I'm not an LNG engineer, so I don't know how long that would take, but I would imagine you can't start those repairs in the middle of a war. So this is sort of elongating the potential time frame for the energy price shock.
I tell you what, the day rate on these gas fields at the moment must be a pretty penny.
I mean, talk about fucking danger money.
I'm tell you what, I'm half tempted to go over there with a fire extinguisher.
It may be worth a visit. But yeah, so I think that's important that a sort of new front has opened up on the geopolitical front. We have heard from President Trump. He was cited by the Wall Street. Go on.
No, sorry, I thought you were just on about Truth Social post. Did you see that?
Oh, yeah, I was going to come to that in a second. So we heard from the Wall Street Journal who said that Trump wants no more strikes on Iranian energy sites. The Wall Street Journal was saying that Trump believes Iran got the message and he's now against attacks on Iranian energy infrastructure. But then about 3 hours later, Trump put out a post on Truth Social, as Ryan said, saying that he had no advance warning of the Israeli strike, which isn't correct because apparently he did. He then warned that if Iran attacks Qatar again, the US will, quote, massively blow up the entirety of Iran's South Pars gas field. So much for we're not going to do this again. We might blow the entire bloody thing up.
And he quantified it with he was going to blow this up at an amount and strength and power that Iran has never seen or witnessed before. I do not want to authorize this level of violence and destruction because of the long-term implications it will have on the future of Iran. But if the Qatar's LNG is attacked again, I will not hesitate to do so. Thank you for your attention on this matter.
This thank you for your attention to this matter thing is bloody ridiculous.
My good friend Nick, who actually funny enough, next week we are launching a platform for anyone involved in agricultural markets. We're putting together a really cool information platform for agricultural markets. So do get in touch if you want more information on that and you want to get on the beta rollout. Tom, I'm looking at you. But he made a very good point. This Truth Social post used words like pertinent and pertaining to. So
he didn't write that.
So either someone else has written it or the free world is now being powered by Grammarly.
Well, yeah, I would say that the White House intern wrote that, but these days you can never be too sure. But yeah, I think this is, yeah, I mean, we kind of covered the market reaction. It's been obvious, Brent's gone through the roof, TTF has gone through the roof, as you would expect. Stocks took a big old roll lower, Govies selling off across the board. Stirs have gone mental again. I think you look at the Eurozone swaps have got about 60 basis points of hikes in the curve by the end of the year now. I think we've got about 35 bips of tightening in the SONIA curve here in the UK by the end of the year. All rather extreme, but at the same time, I guess kind of logical on the back of market participants, very much elongating their expectations as to how long the energy price shock could go on for.
Yeah.
And, we are now, again, I know we stood at this time yesterday saying we're becoming kind of desensitized to this. Well, we're highly sensitized once again, and we're going to spend all day watching headlines.
And it does tie in with what we said, like when we were speaking about the desensitization of traders and markets to events. I did quantify this by the biggest risk now is it all boots off and people are caught with their pants down. Now, I know a few people, very smart people, as much as I will add that as well, know what they're doing in terms of trading. Yesterday was the day that at least two people I know kind of got back into the market thinking that, the top involve's been seen and now we're going to start, slowly wind back down to normality. Now, I hope they haven't been caught with their pants down, but I think they might have taken a small hit. But yeah, again, and these are very experienced people, like hugely successful traders. So yeah, it just shows you that, complacency does, in this kind of situation, complacency kills. But moving on from the Middle East, mainly because whatever we're saying now might be irrelevant in 10 minutes.
Well, yeah, exactly.
Obviously the FOMC yesterday, my dear friend. Now, as we've said before, so I'll caveat before you go on, we have said before last night's or before yesterday's stuff, like kick off in the Middle East, that this week's central bank's decisions were probably completely irrelevant because they're all based on information that's happened before the war. So even more so now because of the latest energy shocks in the UK as for Europe. But what's your impression on what's been going on in the Fed? Was it very much as expected?
Yeah, I think it was. I mean, just to recap, obviously the Fed maintained the target range for the Fed funds rate between 3.5% and 3.75%. It was an 11-1 vote. Governor Myron was the only dovish dissenter at what may well be his last meeting. The statement was very little changed, as we expected. I think one of the Bloomberg reports said that the Fed changed 40 words in the statement, and 4 of them were the date, which kind of gives you every idea as to how much of a carbon copy that was. The most notable change was that they did add in reference to developments in the Middle East, saying that, and I quote here, implications of developments in the Middle East for the US economy are uncertain. Frankly, there is not really a lot else they can say at this moment in time. The projections, I mean, even Chair Powell himself actually said at the press conference, even more than usual, take the forecasts with a grain of salt, and I think everyone would be wise to do so.
Just for those unaware, so basically what you said is ignore the dot plots. We don't like doing them.
Well, no, I mean, yeah, and he actually said, if there was, he actually said at the presser, we would never just skip an SEP, but because it's too difficult to do it. But if there ever was a time to skip one, now is when we would do it. So yeah, you're absolutely right. They don't want to write down these projections. They don't want to do the dot plot. They know they're not worth the paper that they're written on because the outlook's so fluid.
It's not millions to one, like you said, that Walsh just despised the dot plots.
I would be pretty sure he will at this point.
And to be honest, the only people that would be against that are economists and journalists.
Yeah, I think he should ditch it day one. But there we are. The dot plot was actually unchanged. So continuing to signal 125 basis point cut this year, 125 basis point cut next year, and then none in 2028.
That tells you something in itself, right? It just tells you that they probably sat around it'd be interesting to see what the minutes say, because in my opinion, they probably sat around the table. They've gone, well, what the fuck are we going to put now? Let's just leave it as it was before. Let's
manufacture an outcome that's unchanged from where it was 3 months ago. Are
you going to go on to my friend Mirren?
Well, there's not a lot to say about him apart from he dissented in favour of a 25 basis point cut. I would expect to get a statement from him on Friday explaining the reasons for that.
Oh, I saw someone saying that he was suggesting a hike.
I don't think so. Unless I've completely misread the statement, but I'm pretty sure he did not do that. Let me find voting against this action was Stephen L. Myron, who preferred to lower the target range for the Fed funds rate by 1/4 percentage point at this meeting. Someone on Twitter's talking bollocks again.
Yeah, someone. That is weird. I saw someone posting about him and a hike, but that was very weird.
Well, he didn't. In any case, just quickly on the remainder of the Fed, the press conference was pretty much as you'd expect. Powell saying that the current stance is appropriate. They will react as necessary. Very much a focus on longer term inflation expectations being at 2%, as opposed to where spot inflation is at this moment in time. I guess the most kind of newsworthy part of the presser was actually on Powell himself. He said that he has no intention of leaving the Fed board until the Department of Justice investigation into the Fed is, quote, well and truly over, and that he has not made any decision as to what he will do after that investigation has concluded. Recall, of course, that Fed Chair Powell's term as chair comes to an end in the middle of May, but his term as a governor does not expire until the end of January 2028. He has every right to serve out that term as a governor if he wants to. It looks like he will serve out at least a portion of that term based on what he was saying last night. He also confirmed that if Kevin Warsh is not confirmed in time to replace Powell as chair, then Chair Powell would serve as chair pro tempore, essentially an interim arrangement until Kevin Warsh has been confirmed by the Senate. But really, that was kind of the only newsworthy line from the FOMC yesterday. It was very much a case of we are in wait and see mode. We have as little idea as anyone else as to what's going to happen next. We're not going to overreact to what we're seeing. We just want more information. And actually, just to cover it off very quickly, that's exactly the message that we got from the Bank of Canada yesterday, who also kept rates unchanged. It's exactly the message we got from the Bank of Japan overnight, who also kept rates unchanged. And from looking through the headlines that have crossed while we've been doing this call this morning, it's also exactly the message that we've had from both the Swiss National Bank and from the Riksbank in Sweden, who have also both stood pat on policy and essentially gone, we are just in wait and see mode. Yeah. We will adjust policy as we need to, but we need more clarity on the outlook before we give any sort of explicit guidance as to what those adjustments may be.
Just quickly regarding my mate Stevie M, it's the Reuters article is about that he sees a rate hike next year, and apparently he's the only policymaker to do so.
Well, he won't be there next year, sadly for you, so I guess that's slightly moot.
Let me dream.
Go on. Anyway, more central bank decisions today, isn't there?
Oh, God, yeah. To be honest, though, look, we can keep it fairly short and sweet on this because everyone's going to be following the same playbook. No one is going to be making any decisions because of what's going on in the Middle East. Obviously, Australia, yes, they hiked this week, but you could argue that they're slightly kind of...
Well, there's idiosyncratic factors driving the RBA because they were, even before all of this kicked off, they were dealing with a very tight Aussie labour market and also inflation that was relatively high and rising. Yeah. Whereas if you contrast that to the other, 8 G10 central banks, and exclude the BOJ from this, but if you contrast that with the other 8, they were dealing with labour markets that were relatively loose and loosening, and inflation that was either at target or on a sort of gradual glide path back to target. So very, very different environments.
No, exactly that. And I think, it's going to be basically BOE and ECB is going to be basically, in my opinion, repeats of kind of the same format as what we've seen with the Fed, which is that no change. Also, we've got to sit on our hands. We've got to wait and see how this develops. And to be honest, that is the prudent course. Now, the only thing potentially that will be weighing on the Bank of England, more so than the ECB, I think, in my opinion, personally, but I hear very interested to see what you think on this, is that if it wasn't all kicking off in the Middle East, they would 100% be cutting, in my opinion, because the economy is going from bad to worse. And we see, we've got stagflation in the UK, right? But also we've got, the latest wage data came out this morning, and I kind of said tongue in cheek when I requoted you, but it wasn't. I actually truly believe it. What we're seeing in the UK, I think it's worth chatting about briefly, is public sector pay is going up constantly and going up at a faster pace, increasingly so. Private sector pay is not doing so great. It's shrinking. It's still going up, but is it above inflation? It's very close to being below inflation at this point. I am utterly convinced at this stage that the reason why the Labour Party is so happy to keep giving in to public sector pay demands and boosting in public sector employment, whereas they did say they'd be reducing it, etc., is because they're doing it to fudge the numbers, the overall economy numbers, and make it look like that the economy is much stronger and the job sector is much stronger than it really is in the real world. What are your thoughts on that assumption?
Yeah, I wouldn't be surprised. I think it may be slightly more nuanced than that, because I think you might be giving Labour too much credit for actually having thought of that. I think it's more the fact that they're just in hock with their sort of union paymasters who are, basically ordering them to conduct these pay rises. Just on this subject, though, Callum Pickering, who's the main man over at Peel Hunt,
He's very good, very good.
He
You
is
don't follow
very
him already.
lovely chap as well in the pub. He's a good lad.
Well, all right. Thanks.
Much nicer than you.
Thanks, right? Yeah.
He put out a tweet this morning basically charting all of this, and I like the way he framed it, where he said, if the plug hole runs faster than the tap, eventually the bath will be empty. And I think he's absolutely right, because you've got, the private sector stagnation, public sector earnings growth going through the roof. Simply, we can't pay for it. We can't afford it.
No.
But there we are. That's nothing new. Just on those BOE and ECB decisions, the two things that I will be looking out for, one in terms of each, neither expected to change policy for what it's worth. On the BOE, I think the focus really needs to fall on the minutes, and particularly those little paragraphs that each Monetary Policy Committee member gets to explain their own view. And the reason why I think this is so important is because the BOE is basically a vote counting exercise at this point, and those paragraphs will allow policymakers to explain, are they in the camp that I would imagine Hugh Pill and Megan Green are in, which is, this is another supply shock, this introduces a risk of inflation expectations unanchoring, we need to tighten up or we need to stay restrictive? Or are they in a camp that you'd probably find Alan Taylor and Dingra and the Dovish members in, along the lines of energy price inflation, it's likely to be short-lived, it's likely to be temporary, we can look through it, the economy, the labour market has a lot of slack in it, we can look to ease policy once we have a bit more clarity. So I think those paragraphs are going to be key for the Bank of England. Switching over to the ECB, they're obviously not going to change policy settings either. I think the key thing with the ECB will be whether Lagarde makes any sort of endorsement of the idea of policy tightening at the post-meeting press conference. Of course, markets have got very, very hawkish in terms of where they're priced at the moment. But more importantly than that is going to be the sources stories that we get after the meeting. That will tell us what's really gone on in the room, what's really been discussed, and also whether there is the potential for any policy tightening or if they're going to look through things. So for the BOE, look at the minutes, read those very closely, look at what those 9 members have to say and how they group together and how that could game out the policy outlook. And then for the ECB, it's all about those sources stories, which with that lot in Frankfurt, they could drop basically any minute from the decision dropping itself onwards.
Yeah, just as a rule of thumb as well, the sooner that the sources comments drop after
the more disharmony there is.
Yeah, exactly that. When we get sources comments before Lagarde even starts speaking, you know that there's some fracturing in Brussels. Well, even more fracturing than normal. But but again, pull up your PIQ platform or use a new mobile interface, etc. Actually, I've got maybe a little beta launch I can launch today, which is a new way to monitor the situation from your computers, etc. By PIQ, which is really cool. Also, big shout out, we've also got Bloomberg TV and stuff like that on there, so do use PIQ for all of that, and it's free. But yeah, whatever you're doing today, obviously keep one eye on the headlines more so than what's going on in central bank world, etc. Do keep your powder dry where you can. Do preserve capital. That's what the game is at the moment, preserving capital. You're not going to make your year in a day, but you could lose it in a day, trust me. But Michael, thank you so much for that. Listeners, thank you as always. Really hope you have a good, profitable day. If the sun is shining, try and get some sun on your face, because it really does make you feel a lot better about yourself and your trading positions. But yeah, whatever you're doing, take care, keep it tight.